There's many fun F words out there, but today we're going to focus on the word fiduciary and what it means in a financial planning relationship. We're going to specifically drill down to the fiduciary levels of responsibility to clients and to the costs associated with services and products. Welcome to Financial Planning for Feds. I'm Ed Smith, President of Valor Wealth Partners, where we are dedicated to educating federal employees on how to maximize value from their government benefits by developing and executing a financial plan. As always, we have an ebook for you to follow along with or to review after this video in case you don't want to watch the video again. If we're going to understand the term fiduciary, we need to look at the definition. According to Investopedia, a fiduciary is a person or organization that acts on behalf of other person or persons, putting their client's interest ahead of their own, with a duty to preserve good faith and trust. Being a fiduciary thus requires being bound both legally and ethically to act in the other's best interest. Let's take a closer look at the levels of responsibility. This diagram is going to illustrate the outer circles being the less levels of responsibility, and the closer to the center is the more responsibilities that I feel a person should have when they're working with clients. In the outer ring is government regulations. These are the laws that are put in place to protect consumers. In my opinion, it's the minimum standard that anybody should be following. In June 2019, there was Regulation Best Interest that was brought out by the Securities and Exchange Commission to help protect consumers more. This did a great job to protect clients and let them understand more of what investment advisors and financial planners are doing and how they're working. I do feel it fell a little bit short, and it wasn't going across the board to make it very consistent and understandable for everybody of how a fiduciary acts in different capacities. We have a couple of resources that you can look to check up a firm and an individual to be able to see if they're acting and if they have had any disciplinary actions, the length of history that they've been in business, and anything that is on their permanent record as a financial advisor. Going into the next level is industry codes. Now, this is where certain things like being a certified financial planner professional, or commonly known as CFP, comes into play. Now, I'm a CFP, and I take this obligation of being a certified financial planner professional very important. The CFP board has come out with the fiduciary duties that we, as certified financial planner professionals, need to be following to maintain our credentials. According to these fiduciary duties, they state, at all times when providing financial advice to a client, a CFP professional must act as a fiduciary and therefore act in the best interest of the client. The following duties must be fulfilled: duty of loyalty, duty of care, and duty to follow client instructions. The Certified Financial Planning Board has done a lot to improve the integrity of this industry. I've added a couple of links in the description area so you can research a little bit more about what they are doing to help promote good conduct and best practices. In the next ring, we are looking at company rules and how a company is ensuring that their employees are taken care and making sure their clients are taken care of and following fiduciary standards. Now, many times companies only follow the legal responsibilities of what they have, and sometimes they aren't even following the industry standards that we talked about. At Valor Wealth Partners, we took this a step further. We have a fiduciary oath that every employee must sign. We put it on our website so everybody can see our pledge to our clients. Even our comfort manager, Everett, has his fiduciary oath on the website. A company further has the responsibility to make sure their employees are educated. This is very important, especially when they hold themselves out to have a specialty or specialty knowledge, such as we do with federal employees. Federal employees have a very complicated benefit system, and you have to have special knowledge and education to make sure you're taking care of those clients in a fiduciary level. Over the years, I've had many titles doing the same job. This can be very confusing to clients. Some of those titles I've held over 20 years is financial consultant, financial advisor, wealth management advisor, financial planner. So these titles have very different names, but yet do the same job. And it's very understandable about why clients are confused. Sometimes companies go as far as calling their advisors vice presidents. What does a vice president really mean? And how many vice presidents do they have? I've never been a vice president of a company, but this is very confusing and it seems like it's an elevated position, while sometimes there is very little criteria to achieve that title. You really have to do your research of what the title means, but also what the responsibility in that position are. The final point I want to make about a company's role and their responsibilities is the awards they give to employees. I've received many awards from the different companies I've worked in the financial service industry. And almost all of them were about how much money we earn from our clients. It was never about how much good we do. And to me, this is a shame. We promote and recognize people of how much revenue they generate versus the good they do to people and the families they help. We should be better as an industry, and we have a responsibility, a fiduciary responsibility, to make sure we're doing better for our clients. This brings us right into the next area, personal standards. This is the center of the circle. As fiduciaries, we have an obligation to be better than the system. Our relationships are built on trust, and we have to make sure that trust is built on integrity, on a person's personal integrity. Now, a character can only be seen over time, and it's very hard to see that at the onset of a relationship. So we have to do everything that we possibly can to show the people that we care and they can trust us to be the fiduciaries that they need for them and their family's future. I have a personal code of ethics that I created a few years ago and I live by. It's very rare that I share this, and it's not on our website. But it's something that I look at from time to time to make sure that what my standards are personally and what I am as a core is something that I follow. Please take a look at this, share it, use it, and I would suggest that you actually build one for yourself, even if you're not in the financial services business. Another major part of being a fiduciary is looking at the cost of services and products we offer to clients. Now, there's really two parts of this: the cost that a client pays and the income that is received from a business from those services and products. Let's first dig into the cost to the clients. One of the things a fiduciary has to do is look at the transparency. And can a client or a potential client understand what those costs are and what they will be paying? We want more transparency in the industry so more people can understand upfront what they're being charged before they're being charged. And they have plenty of time to look over any documentation before they sign on a line. A client should never be rushed. When you look at cost, it should come down to a simple equation, and for each person it could be different. That equation is the benefit of the products and service minus the costs, and it will equal a perceived value. If you are not getting a perceived value, you shouldn't buy the product. The second part of the costs is the income that is earned from a company or individual from the products or services they recommend to a client. This area has many conflicts of interest, and it is very important for a fiduciary to be working in the best interest of their clients at all times. We've put together an illustrated video that explains the potential incomes an advisor can earn for their services and products. Hopefully this will clear up some of the misconceptions. Welcome. In this video, we are going to explain common ways financial advisors get paid. First, I want to clarify that how an advisor is compensated may be different than the cost you pay. You can use a simple calculation to see if the price you pay for financial guidance is good for you. The benefit you receive minus the cost you pay equals perceived value. Once you find an advisor you feel will generate value for you and your family, you should also understand how they are paid and if this may influence their recommendations. To illustrate the differences in compensation, we will look at a few advisors. Meet Sally. She embraces change and is a fiduciary at all times. This is Bob. He has been helping clients for many decades and believes everything is good the way it was. Even though they are different in many ways, both advisors are ethical and feel they work in their client's best interest. Let's take a closer look. While Bob has seen many changes in his long career, One thing that has been around long before him is commissions. When an advisor receives a commission, they are getting paid by a company to sell a product. Bob has a duty to ensure the product he recommends is suitable at the time of sale, but he does not have an obligation to support the client in the future. Let's look at a few industry averages for products that are typically sold by commission. 2 to 8% for annuities, 3 to 6% for mutual funds, 80 to 100% of first-year insurance premiums for products like life and long-term care insurances. Here's an example. Mary has $500,000 to invest as part of her investment portfolio. If Bob recommends an annuity, he would get $25,000 based on a 5% commission, which is the middle of industry averages. While an annuity may be the best solution, it is human nature for Bob to calculate his payment as soon as he sees the opportunity. Because of these upfront commissions, these types of transactions can cause conflicts of interest for Bob. Even though they may be significant conflicts, Bob is not doing anything illegal. Sally works on a completely different compensation model and from a more client-centered mindset. Over the last few decades, major changes have occurred to advisor compensation where the advisor gets paid by the client instead of a company selling products. This model is called fee-only. In this structure, advisors act as fiduciaries at all times. Sally receives fees over the duration of a relationship with the client. If Sally doesn't live up to the arrangement she agreed at the beginning, she could be fired and lose money. Because of her fiduciary duties and the structure of her compensation, Sally is aligned with the client's needs. Just as we did before, let's look at a few industry averages for typical fees. 1.02% of assets under management at a $1 million breakpoint, $1,200 to $1,500 to develop a financial plan, or $5,000 annually for a retainer or subscription model. Here's the same example as before. Mary has $500,000 to invest as part of her investment portfolio. Sally would most likely create a financial plan at a cost of $1,350 to assess Mary's needs based on more in-depth analysis. After reviewing her plan, Mary has the power to determine if she will receive a long-term perceived value based on the details Sally outlines. Mary could choose subscription, assets under management, or maybe a combination of models. Services vary depending on the type of work performed by the advisor. If Mary chooses to work with Sally using a subscription model, based on industry averages, Mary would pay a $5,000 fee a year. If she chooses an asset under management fee structure instead of a subscription model, she would be paying the same $5,000 as a 1% fee. If you have never explored fee-only compensation, it might take a little longer to understand. In our opinion, it is more aligned with a client's long-term needs, is extremely transparent, and helps to reduce conflicts of interest. But wait, there's one more advisor to discuss. Meet Richard. He can be a little tricky. Richard uses a term called fee-based. In this model, an advisor can use both commissions and fees. We stated earlier that either compensation program can be ethical. Unfortunately, the name misleads consumers and lulls them into believing it is the same as fee-only. This model is very different, and you should know when an advisor is acting as a fiduciary and when they aren't. When we look at the term fiduciary, we really want to look at the heart of the word. And for us, it's integrity in building the trust with our clients to make sure that we're always acting as a fiduciary. We hope that everybody in our industry is elevated to a fiduciary standard and is following the general practices that they should be looking at to take care of a client. This is a very complicated subject, and hopefully today you've learned a few points of why we take this responsibility so seriously. Thank you for your time today, and we look forward to educating you in the next video.